Well, U.S. job growth soared far beyond economists' expectations last month.
This comes in spite of high interest rates implemented by the Federal Reserve in an effort to cool inflation. The Labor Department revealed today U.S. employers added 336,000 jobs in September. Unemployment remains steady at 3.8%.
This unexpectedly strong jobs report follows the Federal Reserve opting not to raise interest rates last month. Nonetheless, the federal funds rate remains at its highest level in more than 2 decades. Colby Smith joins us now. She is a U.S. economics editor for the Financial Times. Colby, welcome. So the number of jobs added doubled some economists' expectations. Why does hiring remain so robust?
So I think it really all comes down to the consumer. At this point, Americans are still spending, and they're spending strongly. They have stockpiles of savings amassed since the start of the pandemic, really. Those reach record levels, and yes, they're being drawn down to a certain extent, but they're still quite elevated. And so when you have a strong consumer spending still quite robustly, it leads to a situation where employers, still have to hire. And that's really what we saw in the September report. There's just really no shortage of demand across the labor market.
Now, the Federal Reserve wants to see a slowing of the labor market as officials fight to bring down that inflation. So should Americans actually be concerned about the strength of this jobs report?
So that's a big question that we hear every time there's a piece of strong economic data. Does the U.S. economy's resilience, does that mean the Fed needs to do more? I think at a certain point in the tightening cycle, that very much would have been the case. But this is also happening at a time where we've seen pretty seismic moves in government bond markets. So U.S. borrowing costs have spiked quite dramatically over the past couple of weeks, really, since September. And essentially what that can do in some way is offset the need for the Fed to do more in the end in terms of interest rate increases. The bond market is kind of doing the Fed's work for it. So that's what's making the upcoming meeting more of an open question than I think it otherwise would have been had this report just been kind of in its on its own.
Well, we should note that this massive job growth is really coming at a time of immense uncertainty for the U.S. government. Is it only a matter of time, some might be wondering, before we see the economy sharply decline?
So that's the speculation, and we see it with regards to certain pandemic relief programs, lapsing. We have student loan debt repayments restarting again. Child care federal subsidies are also ending. There's this worker strike, auto worker strike, as well as a number of other headwinds from including spiking energy prices. So there's a lot to be concerned about, I think, about the trajectory of the economy going forward. And still, we haven't seen the full effects of the Fed's past actions to date in terms of its interest rate increases. So taking it all together, there's a lot of expectation that the economy is going to slow from here. But that being said, people have been consistently surprised by the strength of the economy, and it could well mean that that slowdown is just delayed further into the future.
If I recall correctly, it's been the last 2 years we've been waiting to see a big recession hit, and it has yet to really hit.
Yeah, and consumer spending, as you note, really has been a driver, right? We'll see how long that keeps up. Colby Smith, Colby, thanks so much for your reporting and analysis. We appreciate it.